here's one I want to ask you, Mr. X. The income riders, which I mean, they are commodity products. When people want future income, we shop all income riders for the highest contractual guarantee. But explain that you told me this a while back, and it's never left me. How the fees on an income rider are calculated and why annuity companies have the big buildings, understanding that the income rider fees come out of the accumulation value, which further waters down any potential return. Talk about that.
Well, it gets better than that. They always get their fee. See, this is what the people don't explain. This goes back to, it's not the product's fault.
Right.
It's the agent.
Correct.
It's the advisor. It's the whatever name you want to give them. It's their fault because they don't explain it. Because I think if I explained it in full detail, you might take a deep breath before you jump, to say the least. Okay.
Exactly.
The challenge with the income rider is the way they were originally presented was people thought it was real money. Is it real money, Stan?
It's a monopoly money in a phantom account, and Jimmy Carter yield doesn't exist. He's building houses in Georgia, hopefully, if he's still alive.
And then some. So the way the fee works is very simple, and you can demonstrate this with just get a bunch of change on a table, and I'll show you is every year, we'll just say it's 7% because this makes easy numbers. I put $100,000 in, I have a 7% income rider, I'm at $107,000 in my income account. So put that on the right side of the ledger.
Mm-hmm.
And then say the account returned 4.5%. My real value is 104.5, 104,500. The fee's 1%. That's pretty standard.
Right.
Right. They take 1% off the 104. It gets deducted. I'm sorry, it gets deducted from the 104. They take 1% from 107. So that's $1,070 off of the 104.5. Next year, we'll say it does 0. My income account's 114 and change.
Mm-hmm.
It's compounding. My account is 103 and change. Now they take that 1% times 114 and subtract it from the 103. The company always gets paid the most.
And as long as you defer that income rider, that fee is increasing by that lovely percentage that you think and it was sold as yield and it's not. It's increasing by that. And then once you do turn on the income stream, Mr. X, isn't that growing fee locked in permanently?
Forever. They're going to take that cut forever. So let's do it this way. Everyone knows at 10 years, 7.2% interest, your money doubles.
Correct.
So your 1% fee in year 1 at the end of year 10 is now 2%. How did we get there? Well, your 100 grew to 200, didn't it, Stan?
Correct. From contractually, the income rider side is worth 200,000. It's monopoly money in a phantom account. You can't cash in or get the interest, but that's where the lifetime income stream is going to be calculated at 200.
Right. So your monopoly money, the insurance company's real money.
Correct.
And they take that monopoly money account and multiply that and deduct it from your real money. Now, here's the wild part.
For the life of the policy.
For the life of the policy, they always get their cut forever.
Right.
It's their annuity. It's the insurance companies. The income rider is their annuity stream that they get paid forever.
Exactly.
Here's the craziest part. People think, well, if I live long enough, I'll beat the rider. You're going to have to live to maybe 110, 120.
To beat the whole thing. It is a transfer of risk.
And here's why. Let's go there. They have taken fees for the first 10 years that you were accumulating.
Correct.
We'll assume you turn it on at the end of the start of the 11th year, you turn on the rider, right?
Correct.
Now I'm year 11 and I'm living. They still are taking the fee, right?
Every year out of the accumulation value.
Now the sales pitch is it's guaranteed income forever. You'll never run out, which is important.
And it's true.
And it is true and guaranteed contractually.
Sure.
But they keep taking that fee. So when you finally spend all your money, the insurance company will keep paying. But think about it. Let's say this whole thing took 25 years. Right. I accumulated 10 and I lived 15. That's 25 years of fees that they've collected.
They're going to win, and I think you've come to
They're just paying you your fee money back. That's all.
No, and you've come to the annuity fork in the road, and this is what I tell people: annuities are contracts. You either like the contractual guarantee or you don't. You have to come to the reality that the annuity company is going to make their money, but you're transferring the risk to the annuity company to pay you a lifetime income stream, whether that's an immediate annuity, a deferred income annuity, a qualified longevity annuity contract, or an income rider. These are pension type products. But you already own, if you're a citizen of this country, you already own the best inflation annuity on the planet. It's called Social Security. I think what Mr. X is trying to say is nothing's for free. Now, the other thing I want you to talk about is what percentage of the time when someone attaches an income rider to an indexed annuity, does the accumulation value exceed the income rider value?
I have to answer that?
It's really low or zero, correct?
I would say it's so beyond rare. Well, let me just do this for you. I'll give you an example. If you buy a capped product, never. Because 4 will never beat 7. Fair?
Ever. And I think that annuity companies are smart. They want lifetime fees on the policy. So when an income rider is attached, they know that person has to stay in the policy, because if you wanted to transfer that policy, the income rider benefits don't transfer, just the accumulation value. So it's really, I call handcuffing you into the policy. That's not a bad thing if you need income down the road. You want it to be, and you want to know to the penny what that's going to be. But just understand, for the people out there that have already purchased an indexed annuity with a rider, don't just watch the rider. Don't just think it's Jimmy Carter yield. Turn on the income stream, transfer the risk, because otherwise, why do you own it?
Hey, Stan the Annuity Man here. Did you like that little taste of my podcast, Fun with Annuities? Hey, if you want to see the full version, click the link and watch the whole darn thing. Remember, Fun with Annuities. Live in the reality, not the dream.